Steve Saretsky here, as always, Canadian real estate market update with a particular focus on Vancouver. If you get any sort of value or entertainment out of these videos, all I ask you hit thumbs up and subscribe. Questions, comments, put those below. This week I want to talk about the skyrocketing insurance premiums, something that's getting a lot of attention in the media. I have a lot of people asking me about it, and then also touch on some Canadian real estate dynamics, things that are happening in the marketplace to pay attention to, which I'll get to in the second half of this video. But first off, the media is reporting here in BC, talking about skyrocketing insurance premiums, that this is a catastrophe. And I have been basically inundated with emails and questions from some of the viewers here, as well as clients asking about that. So I thought I would do basically a video on my thoughts in terms of how that might impact the market and really what is happening kind of behind the scenes. So basically, if you're not sort of informed about what's happening, is basically what we're seeing is insurance costs on property are going way up. You're seeing in premiums spike in some cases in the 1,000% range. To give an example, in Abbotsford, on a one-year-old condo building, the premiums went up to an amount where basically they had to do a special levy, a one-time levy to every single person in the unit for $3,000. We're seeing, what's happening is basically all these insurance premiums are going up, and that's mostly being reflected in an increase in the monthly strata fee. So they're just adding that new cost on. But I think what's happening is the media is portraying this as like this is catastrophic, and like people are interpreting this that because of this, home prices are going to tank. This really has, yes, it's going to impact people's bottom line, but truthfully, for the most part, the market isn't really thinking about it. They're not really digesting it. Of course, there's some very astute observers here that are in tune and in touch with the market that's impacting maybe their decision making, but the market is not interpreting that information. So, I think that is kind of how I'm looking at it. And I think we have to understand, it's funny because why are the insurance premiums going up? And it's funny because the insurance companies are saying, they're saying, quote, it's due to climate related events, as if that some sort of climate catastrophe in BC all of a sudden that is causing insurance rates to skyrocket. What you have to understand is how insurance companies make money and their actual business model. So they basically take the insurance premiums and they basically just invest that in financial markets, and in particular safe assets such as government bonds. Insurance companies are actually the largest holder of government issued debt. And so these property insurance companies will basically match their liabilities into a asset of that duration. So basically they'll basically buy government debt bonds, and they'll take the money that they get in from the insurance premiums, invest it, and that will basically help offset, or that's basically where they make their spread. But obviously, when you're in a low interest rate environment, when government debt yields less than the rate of inflation, i.e. it's a real negative yielding return, it's very hard for insurance companies to actually make money. This is particularly impacting not as much property insurance companies, but that's certainly one of them. They're stuck in this low rate, low return environment, so they have to naturally increase insurance premiums. But this is actually particularly impacting life insurance policies. So you can expect that they have to match their durations, 20, 30 years out. Well, if you're an insurance company in Europe, you're faced with a negative yielding government debt. So basically what these insurance companies are doing is they're having to go further out on the risk spectrum, and they're basically investing in BBB corporate debt. So one grade basically above junk. And this is actually creating a lot of systemic vulnerabilities that if any of these companies get downgraded, the insurance company is actually mandated to divest out of these because they have to be in, quote, investment grade assets. So insurance companies are actually forced to invest in investment grade debt. So to get any sort of yield, they're making more risky investments, and they're ultimately stuck in a low rate environment, and that's ultimately impacting their profitability and their margins. And hence, one way to recoup that is by jacking up insurance premiums. So yeah, I think this is going to certainly impact the average homeowner that's going to see their strata maintenance fee go up. You can talk about insurance deductibles. I'll give you one example here. We've seen insurance deductibles go from $10,000 to $100,000, upwards of $750,000. So basically, if you get a leak in a condo building, your deductible could be upwards of $750,000. So someone's going to have to be out of pocket unless you pay that deductible, which is obviously a huge deductible to take. So it kind of makes the policy almost irrelevant. But yeah, I don't know really how this transitions. I think at some point the government maybe gets involved, but I don't think it's anything at this point that's catastrophic that's going to actually impact market pricing. What we're actually seeing is still a recovery or a resurgence in the housing market in the affordable segments. So it's kind of switching gears. Is you can see this actually from a national perspective. Again, yes, real estate markets are local, but if we look nationally, we can get a larger picture of the sort of economy and the larger movements that are taking place. And what we saw in the December data was, again, Canadian home prices accelerated, again, up, I believe it's 3.5% on a year-over-year basis. But it's important to contextualize why this is actually happening, what's causing the growth or the resurgence in activity, particularly at the lower end of the segment. So in Vancouver, you have one-bedroom condos catching multiple bids, and large parts of the Canadian metro cities are very, very active in these lower end, mid-range product. What you're actually seeing is basically what's causing this is a drop off in new listings. So basically people are not listing their properties for sale, and this is causing inventory to drop. So we actually had months of inventory drop to the lowest levels since 2007. And new listings are actually at a 10-year low across Canada. So to truly understand this, I think that what is happening is basically why are people not listing their homes for sale? You could argue that for the most part in Canada, prices are at or near or close to all-time highs. Certainly a good opportunity to cash out some of that equity. But I think that because you're in this low interest rate environment, there's no incentive for people to cash out. There's no alternative. Just like an insurance company, there's this hunt and this thirst for yield. So if you cash out, where do you put your money in the safe investment? Do you put it in a government negative yielding government bond? Do you put it into a GIC at 1%? So there's no alternatives. So that's, I think, part of the reason why people are hoarding assets such as real estate. It comes down to a belief and a mindset that not only have we had a 25, 30-year bull market, but you're in this low rate environment where there's no incentives to divest out of things such as real estate and for insurance companies into BBB corporate debt. You don't have the alternative is buying, a Greek government bond that's historically has a high default rate at a negative interest rate. So that's just kind of the reality that you're in. So again, I think that could obviously switch and pivot at some point. I think that's the risk to the market. Certainly you do have a record number of new homes across Canada under construction. That would add to the supply, but at the end of the day, homeowners are opting to stay put, and investors, I guess, are opting not to sell, particularly because there's no catalyst. Catalyst would normally be higher rates, which would force malinvestment to actually divest. They would force them to deleverage, but you don't have those scenarios. Normally, central banks would kill, expansions. They would kill the excessive asset bubbles that are forming, but they're actually doing the reverse. They're actually cutting rates and engaging again in quantitative easing. And so they're actually increasing the incentives or the behaviors to basically speculate in these various asset classes. And so I think that, again, that remains one of the risks to the market. But until that sort of charade comes to an end, this is the kind of environment that we're in. And that's really why you're seeing a resurgence in the national housing market and a lot of these cities as well. So that's kind of what I have for this week. If you have any questions, again, put those below. Otherwise, see you next week.